In the short and medium term, the narrative around any company can shift. You see, back in the early 2020s, SOFI was once labelled as a fast-growing fintech. Now, today, that is no longer the case, with many people calling them a slow and sluggish company. But with his recent commentary, Anthony Noto reminded investors that the SOFI story is not about what is going to happen in 2025 or even in 2026, but pointed to the potential market opportunities in front of them to the end of the decade and beyond. But as always, potential is a dangerous word, so let's dive in. Now, before I begin, I just want you to know that this video is the second video in a two-part series where we are talking about SOFI's valuation. And I think unless we see any significant changes in their business, like the addition of a new business vertical that wasn't previously there, like the loan platform business, that significantly changes their business model, I would actually expect this valuation to stand for the rest of the year. Now, I've also decided to make these two videos to account for the uncertainty that we have in the macro environment, and also to account for some of the things that Anthony Noto told us during the latest JP Morgan conference. You see, at the start of the year, I also made a valuation video, but the assumption back then is that we are going to have a stable macro environment for the rest of the year, but that is, essentially no longer the case. So if you haven't watched part one of these two-part series, I am not going to link it above as usual, because you need to watch the video to the end, right? Retention issues and things like that. But I will definitely leave the link down below for you later on. So during the conference with JP Morgan, Anthony Noto actually discussed SOFI's main growth driver, and that is their member growth. Now, I believe in previous videos I've spoken about how if you consider the credit box that SOFI operates within and the average salary range of a typical SOFI member, I think what you get is around 27 to 30 million total members that SOFI could, possibly go after. And in that video, I also mentioned that if they have desires to become a top 10 financial institution in the US, then in all likelihood, they would need to expand the range of members that they go after, but to do so in a way that does not take on any additional balance sheet risk. Otherwise, they actually risk, continuing to hold that label of being just a bank, right? Therefore, with the introduction of the loan platform business, that has certainly given SOFI an avenue to go after some of these members that are outside of their usual credit box, that are outside of the usual salary range, but at the same time, get these members onto their platform to use other products, things like SOFI Invest and all the crypto products that they plan to introduce in the future. So I do believe at this interview, this was actually the first time we have heard Anthony Noto give us a long-term projections in terms of SOFI's member growth outside of earnings. And I think the way that he was looking at it is actually pretty interesting, right? Because he's looking at it in terms of total number of accounts, and he has told us that, there are over 500 million accounts in the US, and currently SOFI stands at around 11 million members, and so he hopes to get this number to 50 million by 2030. Now, if you have been following my valuation process for some time, you would know that the next thing that we like to talk about after member growth is products per member, because eventually a member will use products and these products generate revenue for the company. And again, all we have to go by is a quote by Anthony Noto all the way back in 2023 that, the products per member number should stagnate in the 1.5 products per member range as they were growing their member base over the last couple of years. However, looking ahead over the next 5 years, he hopes to see this number levels out at closer to 3 products per member, which would mean that people that are using SOFI as their primary bank could perhaps be taking on 5 or 6 products, and those who are using SOFI as a secondary bank account perhaps taking on 1 to 2 products. Now, I also want to talk a little bit about the adoption of SOFI Plus, right? So, SOFI members can actually access the benefits of SOFI Plus in 2 ways. They can either do so by setting up a direct deposit with SOFI or by paying $10 a month. Now, of course, definitely on the surface, the direct benefits that SOFI get is a subscription revenue from this business. However, if you take a look at the previous earnings, it's still not a significant enough number for it to be a line item in the earnings. But in the background, I think what it has done for the business is that it has driven up the product adoption across the existing member base. And so this tells me, that there are perhaps members on the platform who might not have set up direct deposits with SOFI for whatever reason, perhaps in terms of convenience and things like that, but they like SOFI's products and they are willing to actually deepen that relationship with SOFI. Because Anthony Noto told us again during that JP Morgan conference that after they launched SOFI Plus as a subscription, what they noticed is that this actually triggered an increase in adoption of products among their existing member base, many of whom have now taken out a 3rd and 4th product. And I think when we're actually listening to this, some people may actually feel like, Anthony Noto is just trying to hype up the company. But I just want to remind us that this was exactly the same situation that we had with the financial services revenue projections, where they were telling us that they projected to grow financial services revenue above 85% year over year. Nobody actually realized what was happening until the introduction of the loan platform business. So I do believe that, the numbers and the metrics that management is tracking internally is very different from the message that is generally being communicated to investors, which is why, I always have a problem with the way that they're communicating their intentions and their objectives. So in this conference with JP Morgan, Anthony Noto went into a little bit more detail into how they plan to grow the products per member and some of the opportunities he saw. And so the first thing that he actually spoke about is credit cards. So I thought what he actually spoke about when it comes to credit cards was quite interesting, because Anthony Noto mentioned, right, that credit cards company don't actually like it when people pay off the credit cards. And he actually said that, they make money in quite a horrible way when people just pay off their minimum balance and basically let the 22-24% interest actually accumulate, and that is how they make their money. But SOFI, because they are a one-stop shop, they don't have to go with that business model. They can actually offer a way for their members to actually pay off their credit card debt in a very efficient manner, lower their cost of debt, and this will free up more capital for the members to use in other SOFI products that is beneficial for their financial health, and it is in line with SOFI's mission to help you get your money right. So not forgetting, the credit cards business is currently a business vertical that is losing them around $100 million per year. And once this segment of their business turns profitable, it will continue to increase the contribution margins of the financial services platform. So if you remember one of the last videos that I released, Anthony Noto was actually quoted as saying, right, credit cards is actually one of two business verticals that SOFI currently has that could become as big as the entirety of SOFI's business. Now, at the point in time where he first made that comment, I believe SOFI was doing well over $2 billion in revenue. And so to see where it is today and what it can grow into, this shows us a big market opportunity in front of the credit cards business. And that actually brings me to the second business that also has the same growth trajectory, and that is SOFI Invest. Now, he has told us that SOFI Invest has seen the best engagement quarter in the first quarter of 2025, and we already know that they are prioritizing this vertical when reinvesting back into the business, and we are seeing a lot of new product launches and a lot of upgrades into the UI and UX recently. So I think on top of what they are doing with SOFI Invest, I think with the reintroduction of crypto on their Invest platform, that is definitely going to drive an even greater amount of engagement and profitability and new members coming back onto the platform, right? Because when they actually lost their crypto products, what you notice is that the products per member number actually fell, and they actually saw some accounts actually churn off their platform. Therefore, I do think once they reintroduce crypto, they are not just going after the group of people that they lost, people who are buying and holding crypto, but they're also able to introduce new services like asset-backed lending through crypto and things like that, and that opens up a completely new market for them. So I didn't catch this, when I was first listening to the conference, because I was focusing about how it affects, their financial services platform, their Invest platform. But looking at the transcript, I also realized that he says that moving up to crypto will open up infrastructure opportunities for SOFI's tech platform, and they plan to build out this infrastructure for SOFI and offer the same infrastructure to, other fintechs in the space as well. And so as they do that, they can definitely scale this part of the business with their other partners, but I'll talk about the tech platform in a bit. And so what we're going to do here is to actually project out what Anthony Noto has told us. Now, this is a slight spoiler to the video from last week for those of you who haven't watched it, so at least you have some context, right? So we actually expect SOFI to end 2026 somewhere north of 17 million members. Now, if you average it out from where we are today, it works out to be 890,000 net new members added per quarter. Now, we know this member growth doesn't grow linearly, so actually, if you think about it, it's pretty doable, right? Because currently they are growing their member base at around 33 to 34% year over year, but for them to get to that 17 million members over the next 7 quarters, it basically only requires a 31 to 32% CAGR over the next 2 years, right? Which is, more or less around what SOFI has guided for in terms of member growth, 30+%. So from there, with around 17.5 million SOFI members on their platform, to get to 50 million members, 2027, 28, 29, and let's say until the end of 2030, Q4 of 2030, this means that, Anthony Noto expects SOFI to continue growing their member base at a 30% CAGR from 2027 all the way to the end of 2030, right? And with this 30% CAGR number, that's how you get from 17.5 million members all the way to 50 million members, and that is what you're seeing over here. here. Now, the second line that you're seeing is the products per member. This is currently at around 1.46, close to 1.5, and we expect this number to go up to around 1.55 by the end of 2026. Now, from there, if 1.55 at the end of 2026, to expect it to reach 3 products per member by 2030, we would be expecting around a 17.9, call it 18% CAGR over the next 4 to 5 years. Now, the only issue I have over here is that we actually haven't seen SOFI manage to grow these two numbers in tandem, which means to increase the number of products per member and at the same time increasing the member growth, right? But of course, things have changed since then, and SOFI's offering is much more mature right now. And with the introduction of SOFI Plus, I think it remains to be seen whether or not this is actually a possibility moving forward. But this is something that I bear in mind when I'm actually doing my valuations, and you will see that later on. So therefore, when you take a look over here, what you're seeing is that in terms of products per member, it's really anyone's guess how they plan to ramp this up. But the assumption that I'm taking in this valuation is that they will not get to 3 products per member until Q4 of 2030, which means that from 2027 all the way until the first half, in the first 3 quarters of 2030, they should be hovering in the high 1s to perhaps mid 2s in terms of products per member. Now, if you have watched my previous video, I also want to clarify that in terms of lending and financial services revenue, I actually separated out the loan platform business in my previous video, but I've mentioned that I'm not going to do that going forward because there's too much assumptions that need to take place, because how they structure the loan platform business, how many partners, what are the new partners that they are in discussion with to come on board onto the platform, this is really anyone's guess and it takes too much assumptions. So I'm basically going to combine lending and financial services revenue together. So with that, I think what we have seen is that once they introduce the loan platform business, lending and financial services revenue per product jumped from $40 per product all the way up to $46 per product. However, it is also important to remember that currently SOFI are still underwriting loans that are more or less within their credit box and the salary range, right? As they expand the loan platform business, as they get more people onto the platform, they are going to reach members who are outside of their current credit box and salary range, and these new members that are coming onto the platform will perhaps generate lesser revenue for the company and pull down the revenue per product number. So therefore, the expectation for me over here is that as the member base continues to grow, we are going to see revenue per product starts to come down. And therefore, what you're seeing is that this number drops from $44 in 2027 all the way down to the $39, $40 range by 2030. Now, using the same formula as we always do, right, which is the number of SOFI members multiplied by the products per member and revenue per product, what we're able to do is to project out the lending and financial services revenue from 2027 all the way until 2030. Of course, that is not all there is to SOFI's business, because there is one other component, and that is the tech platform. And when it comes to the tech platform, we are finally getting a little bit of light into this particular business segment and to understand how to project it out for SOFI over the next couple of years. I think we already can see in the last couple of quarters that the tech platform, the demand for SOFI's tech platform actually hasn't been great, and we have actually even seen them lose a couple of deals. Now, most recently, they lost Chime, who is their biggest tech platform client, and this really explained the huge loss in the number of accounts on their tech platform. So because of that, I went to dig out the S1 filing from Chime and to see why they actually decided to move off Galileo's platform. And basically what I actually understood from the deal, or from the move of Galileo, is that they actually decided to move off all of their credit card transactions of Galileo. However, debit card transactions are still being processed by Galileo. And I think it is currently unclear right now whether or not they are planning to move this segment of Galileo eventually, or does Galileo have some sort of edge in this particular, debit card market, which is why they have rolled out debit cards rewards with Wyndham as well. Now, personally, my initial reaction to this deal was one of skepticism about SOFI's tech platform, because when I first invested into SOFI, my understanding of their tech platform and the whole thesis behind it is that, it wasn't easy for another company to go out and create their own banking core. And so because of that, Galileo and Technisys actually have a moat, right? Because they're one of the few service providers out there. But Chime actually didn't move their credit card transactions onto another service provider, but they're actually moving it onto this thing called Chime Core, which is basically something that they build up themselves. So to me, from the way I'm looking at the situation, if Chime is able to do it, are there other companies out there that could potentially do the same that are currently with Galileo, and Galileo could actually see them churn off their platform in time to come? So let's tie all this in together with what Anthony Noto said during the JP Morgan conference. Now, he basically told us that they're seeing demand finally come back to the tech platform, and they're going to start recognizing revenue from some of these deals later on in the year, and more significantly in Q1 of 2026. Now, he actually used the Direct Express deal, which is backed by the US government, as an example of one such instance. Now, on top of all of this, he also spoke about 10 separate deals that have a high possibility of closing soon, and these deals will really start to recognize revenue in the first quarter of 2026, and none of these deals are currently generating revenue for the company, right? So he went on to explain a little bit further why they're having some sort of difficulty in finding these deals, and he largely pointed out, because of the uncertain macro environment that we have over the last couple of years, because of inflation and high interest rates, many companies are holding off from doing these deals, and companies are actually more cost conscious. Now, because of that, I think they have lost certain customers over the last couple of years, because these customers decided that they needed to prioritize cost over functionality. However, he has also told us that now SOFI are seeing some of these customers actually come back to them after initially leaving their platform, because their new service provider that they switched to only optimized for cost and was not able to provide the level of sophistication and functionality that Galileo and Technisys actually provides. However, based on Anthony Noto's statements, I'm not sure if we are going to see a deal with a large financial institution in 2025, because he has told us that these decisions have been harder to get from these large financial institutions. I think plus with the uncertainty that we have right now around tariffs, and the recent report that companies like JP Morgan and Morgan Stanley are setting aside more capital for loan losses, I'm not too sure we see a deal with a large financial institution in 2025. Now, personally, after listening to this and tying everything together, I have a little bit of mixed feelings. I think perhaps more on the cautiously optimistic side, because everything that Anthony Noto has told us is bullish, and I do believe that sentiment, at the very least in the fintech space, is shifting. But at the same time, I also have mixed feelings because of Chime leaving the platform. Are they actually leaving due to cost? Because if cost was a concern, wouldn't they just go to another provider? Or are they actually able to replicate the technology that Galileo provides? And I think at the end of the day, only the numbers will tell us. Because if they are able to do so, then are there other companies out there that could perhaps do the same? And so if we are talking about the tech platform, I think I've mentioned in last week's video how I came to the 20% year-over-year growth number in 2026, and extrapolating from there, I'm expecting it to accelerate again to 25% in 2027 as well as in 2028. Then perhaps we see this level off at a 20% year-over-year growth for the last 2 years, 2029 and 2030. Now, what is a little bit hard for me to gauge over here, because every single quarter, or at least in the most recent quarters, every time they have given some sort of guidance around the tech platform, they tend to miss their estimates. And currently, the tech platform revenue per account only comes in at 65 cents. So we don't really have much information to go off. So if we start with this 65 cents of tech platform revenue per account number and grow this to $1 over the next 5.5 years, with the growth rates of the tech platform accounts that I was mentioning above, the tech platform revenue that you will get from 2027 all the way until 2030 is indicated over here, and that is just one problem. Because if you zoom in to the 2030 numbers, I think you will notice that by then, the tech platform will only make up 7% of SOFI's entire revenue. And if they are expecting some sort of tech multiple to be applied to their earnings, then this result is definitely not going to get them that multiple. Because the initial premise of SOFI's entire business that Anthony Noto has told us is that each one of their business segments, lending, financial services, and tech platform, will each contribute to 1/3 of SOFI's overall revenue. Now, before we get into the valuation, I don't know where to actually put this rent, so I'm just putting it here just before the valuation. But it's little things like this that actually make me annoyed as a SOFI investor. Now, historically, SOFI has tended to actually beat the high end of their own estimates. However, during that JP Morgan conference, Anthony Noto seemed to be preparing investors for SOFI not meeting their current 2026 targets, which they have been parroting over the last couple of years, which is 55 to 80 cents of EPS. And to me, this is just going to become a lingering topic for the bears over the next couple of quarters until they address this. And I think if they come out in Q4 of 2025 and guide for 55 cents or even less than 55 cents in 2026, people are going to be extremely disappointed. And I think back to Alex Cup and Palantir when I was, investing in Palantir. During that point in time, Palantir was actually growing in the mid-teens. And at that time, he said that, we are going to achieve a 30% CAGR, and nobody believed him. But he maintained that message all the way through. And I think investors are really seeing the rewards of that now. So for me, all this does is to sow, seeds of doubts into my valuation for the company, because at a 40 times PE, if SOFI only makes 55 cents of EPS in 2026, right, their valuation would come in at around $22. But if a 40 times PE is being applied on 80 cents of EPS, then their valuation would come in at $32. And that is nearly a 50% swing in valuation. And at this point, I also do want to mention or to address this a little bit, because I've seen some of you ask me this in the comments. Isn't a 40 times PE too high? Now, my response would be yes, if they were a slow growing mature company. But this is a company that has just turned profitable. And, on the 4th of April, right, at peak fear, they were only valued at 23 times PE. So to me, using anything below 23 times PE, even going to the end of the decade, might be a little bit too conservative. Now, I think where they are now, in the low 30s in terms of PE, especially if they can maintain the growth rate, is actually pretty fair value. And if they achieve what Noto actually sets out to do, right, 50 million members, 3 products per member, then I think 40 times PE for the growth rate that they are putting up, especially if you use the PEG ratio instead of the P ratio, I think it is a reasonable valuation. And so let's look at the possible valuation beyond 2026 going into 2030. Now, a quick reminder that this is really just a fun thought experiment to project out the different valuations of the company depending on different scenarios. This is not a definite price target or me saying this is what is going to happen for the company. I'm using Anthony Noto's own words and working back to see the valuation for the business. So we are going to explore this in 3 main scenarios. The first one, like I mentioned, will be using Anthony Noto's own projections. And then I think you have to bear in mind that between now and 2030, there's still 5.5 years. So we don't exactly know how they plan to get there, which is why I'm not going to focus that much on the individual numbers. But what we hope to do is to look at where SOFI is today and some of the possible ways that they can get to Anthony Noto's target by 2030, and what are the potential valuations if they reach that target. So in this first projection, SOFI grows member count at a 30% year-over-year CAGR from now all the way until 2030. Now, this will literally get them to just over 50 million members by then. So if you look at the products per member, this currently stands at 1.46, and by 2027, we hope to see this rise up to 1.7 and slowly increase to hit 3 products per member only in Q4 of 2030. So you notice, even in the first 3 quarters of 2030, they never ever hit that 3 products per member number. It's only in Q4 of 2030 that we see the 3 products per member for the very first time. Now, in terms of revenue per product, I've already mentioned that I expect this number to actually decline slightly as they get more members onto the platform, because the newer members that are outside their credit box, outside the salary range, will tend to actually bring in lesser revenue. So as you can see over here, lending and financial revenue starts from around $44 of revenue per product and then basically drops all the way to $39 of revenue per product by 2030, which gets you to a full year lending and financial services revenue of around $19 billion. Now you can see the tech platform accounts is growing at around 25% year over year initially, before slowing down to 20% year over year. Now in terms of revenue per account, we basically project this to grow from 65 cents to $1, and the revenue that you get from the tech platform in 2030 will bring the full year revenue to around $20 billion. Now if you do the math, you will realize that the tech platform by then only makes up around 7 to 8% of total revenue, and that is why, like I was mentioning earlier, they might not get the tech multiple that they desire if they continue to operate at this pace. And so the second table I'm going to show you over here basically sums up the quarterly results, and you can see the annual growth rate. And what this would mean is that we expect SOFI, or Anthony Noto expects SOFI, to grow revenue over 40% year over year and to operate at a 20% net income margin, assuming a 3 to 4% dilution every year. Now, if you can see the second half of this table, basically I'm showing you the different PE ratio to be applied to the earnings. And I've mentioned previously, PE ratio is really an expression of the sentiment towards the company, and then you can see the corresponding CAGR at today's price, right? So I've given you a range of PE over here depending on how you assume the sentiment towards SOFI is at that point in time. So for me, I believe that by 2030, If they haven't scaled their tech platform, then their multiple should be between 20 to 30 times PE. And if that is the case, you can expect SOFI to be trading anywhere between $54 and $81. Now, even then, that would represent a 29 to 39% CAGR from where they are today, which is honestly not too bad, right? So in Anthony Noto's projection, you more or less 4x your money over the next 5 years. However, Anthony Noto did say that all of these were just aspirational goals, and in all likelihood, right, SOFI might not actually achieve these numbers. Now, could he be sandbagging? He actually knows that they can hit these numbers, but he just doesn't want to build up the expectations. Potentially, yes, but at the same time, I always say in this channel that potential is a dangerous word. We don't go off our valuation by our most bullish scenario, but we take a more conservative approach. So I want to take a look at a discounted version of how his vision for SOFI could actually play out. Now, to me, I think it is logical to assume that member growth might slow down from a 30% year-over-year growth rate all the way down to 15% year-over-year over the course of the next 5 years. Because as they expand their member base, right, it just becomes harder to maintain that sort of growth rate. Now, because of that, with the scale of new members being added onto their platform, it's also going to be hard for them to increase the products per member, as we have spoken about previously. So this only increased from 1.5 products per member, where we are today, to 2 products per member by the end of 2030. Now, but because, the expansion of the member base isn't as quick as in the first scenario where Anthony Noto was projecting out 50 million members, I would expect the revenue per product here to hover between the $40 to even $41 range by 2030 instead of $39, because you don't have to go as far out of your credit box and your salary range, which means that the quality of members that SOFI are onboarding are still of slightly higher quality. Now, if you zoom into the numbers that we are using for SOFI's tech platform, I think what you would realize is that the assumption in this second scenario and the first scenario where Anthony Noto projected out 50 million members is essentially the same, right? Because I think personally, this would be the minimum acceptable level of growth for the tech platform. Now, even then, I doubt that they get any sort of tech multiple in 2030, because by then, if you actually do the calculations, what you realize is that the tech platform only forms 14% of their overall revenue, even with the slower lending and financial services growth rate, which is roughly where they are today. And if they're not, getting a tech multiple applied to their earnings today, they are definitely not going to get one in 2030 with this revenue mix. Now, therefore, by 2030, even in this scenario, with a 20 times PE applied to them, SOFI should be trading at around $34.76. Now, I'm not saying I think this will definitely happen. I'm just showing you possibly the most bearish possibility, right? However, in this scenario, which many people would, actually say is a bad scenario, you still achieve a 19.5% CAGR from now until 2030, which is actually pretty decent. It's not fantastic, but it's decent. Now, personally, I think if the tech platform revenue stays at 14% of overall revenue, then it is likely that they are trading at a similar multiple to where they are today, perhaps in the high 20s, closer to a 30 times PE, but not above 30, right? Because by then they will be a slightly more mature company, and that puts the price at closer to $52, and that would represent a 28% CAGR, close to 29% CAGR actually. So what you actually notice is that depending on your expectation for the business and your assumption about the sentiment towards SOFI at that point in time, your valuation and your price target could really differ pretty greatly if you look at this table over here. Now, personally, for me, the final scenario is what I actually think that they have the potential to do, and I'm actually holding them to these expectations, which is why I'm always disappointed about the tech platform. So what it does is that it uses the discounted version of Anthony Noto's 50 million member guidance, but assuming that they re-accelerate the tech platform. Now, when doing this valuation, I actually corrected one of my own mistaken assumption previously, because I think 2 or 3 videos ago, I was speaking about how the tech platform, the number of accounts on the tech platform had to grow at a ridiculous rate in order for it to keep up with the growth of lending and financial services. But I think what I realized I missed out is that, the amount of revenue generated per tech platform account could grow just as easily from 65 cents where they are today way to $1 of tech revenue per account or even $2 of tech platform revenue per account. Now, especially after listening to Anthony Noto speak about how they see the tech platform business and the opportunity to expand their tech platform offering through crypto by building out different infrastructure that supports all these different crypto products that they plan to bring onto the platform, I do see how they can start to increase the tech platform revenue per account. So to me, in this third scenario, if they can maintain a 20 to 25% year-over-year growth in terms of the number of tech platform accounts and to increase the revenue generated per tech platform account by adding on all these new offerings into their tech stack and get this number to $2 of tech platform revenue per account, then by 2029, the tech platform revenue will contribute to around 20% of SOFI's overall revenue, and this number will be 29% of SOFI's overall revenue in 2030, which is close to the initial projections set out by Anthony Noto, where each of SOFI's business segment contributes to 1/3 of overall revenue. Now, in this scenario, I actually expect the market to reward them with a tech multiple somewhere between 30 to 40 times PE, and that should have SOFI trading between $63 to $84 by 2030. Now, if you take the midpoint of these two price targets, you end up with an average price target of $73.78. And from today's prices, that would actually represent a 36% CAGR from where we are today, just over a 5x return. Honestly, the difference in valuation really depends on the number of variables and execution risk between now and 2030. So yes, while investing with a long-term time horizon is good, it's definitely important for us to know what to expect from the business to determine whether or not this investment is a success or failure, or whether or not it's a good or bad investment. But to say any of these price targets that we are talking about today is a certainty, you are really taking on too much assumptions. And to me, this is just a way for us to understand SOFI as a company, as a business, and to identify, if they're on this trajectory, then it is likely with these multiples that are being applied to their business, this could be their potential price target in 5 to 6 years. So therefore, like what I've done in this video is to give you a variety of different potential price targets in different scenarios. I've only addressed 3 such price targets in this video. You can definitely rewind back the video, pause it, take a look at the different possibilities and see where you feel comfortable with within your own assumptions. And in many of these scenarios, even at today's prices, it actually presents anywhere between decent to good returns, because at the end of the day, we have to recognize that SOFI are still a fantastic financial services company. Now, however, for me, when I position size SOFI within my portfolio, I invested on the thesis that they will eventually become the AWS of fintech and not just their financial services capabilities. So on a personal level, if I'm just looking at the pure numbers alone, right, unless they can flip a switch in the tech platform and to generate the kind of revenue growth that we have seen the loan platform business generate for their financial services business segment. Like I said, this is not out of the realm of possibility, but unless I see something like that, it's going to be hard for me to consider them as a tech company. So right now, for me, SOFI is just a strong fintech within my portfolio, and as a fintech play within my portfolio, I don't actually see a need for me to continue growing this position bigger than what it currently is, and I would rather allocate my capital elsewhere. But saying that doesn't actually mean that SOFI is going to give you horrible returns. I think SOFI, in all likelihood, they're going to be the kind of company that gives you a more steady compounding growth rather than any sort of parabolic growth that we have seen with other companies, and that is not a bad thing, right? I think largely you have to understand that Anthony Noto, the way he operates and the way he is leading the company is different from personalities like Alex Karp and even Elon Musk, and to a smaller extent, even Vlad Tenev from Robinhood, right? Because personally, I missed the Robinhood turnaround. Now, being in Singapore, I had the impression that people still hated them because of the whole GameStop debacle, but he turned the narrative around, and it's really amazing to watch him speak about the company and the way he leads the company and the way that, he's actually pushing the company and the narrative of the company forward. And I'm looking forward to add to Robinhood when they actually eventually pull back. So to me, these leaders are great at communicating their vision. They're great at storytelling and getting investors to buy into the vision. And that is not necessarily Anthony Noto's style, and that is perfectly fine. You see, the more I listen to Anthony Noto, the more I start to understand or start to form my impression of who he is, at least through a screen. And he's not the visionary kind of leader that creates new markets, but he is a fantastic operator who deeply understands the market that he is operating investing in. Someone in the mode of Tim Cook, right, who has made Apple into a hugely profitable business over the last decade. And that isn't a bad thing. But one company that I've invested in has that parabolic growth and has grown 3x from the time that I last bought it. And I'm going to talk more about that next week, and I will see you in the next one.